Thanks very much for everyone showing up. I know you probably don't want to hear from bonds for the first thing out, and I've been told this is an equity meeting, so I always wonder why I got to go first. I've always thought Blair felt sorry for me because I had a plane to catch at 8:30, but I realized that it was just get the bond stuff out of the way and get to the real interesting stuff later on. As I said, we've been managing your fund for 6 years, and really, it used to be, before we started managing it, a pure bond. 100% of the assets in the fund were bonds. And as interest rates declined, Blair and the committee decided that there must be a way to improve the yield on the fund without increasing a lot of risk. So we at Foyston, Gordon and Payne have had what was called an income fund, which would include bonds, some higher yielding equities, and some preferred shares. So we introduced that into the fund in the first year with the limit that you have to have 70% in fixed income or bonds and 30% in equities. We sort of split that between preferred shares and higher yielding common shares. Good companies, some of them, a lot of them smaller companies, but paid substantial dividends above the going rate on the Toronto Stock Exchange. So we wanted to create a fund that would behave somewhat like a bond fund, but at the same time have the characteristics where we could diversify some of the risk so that it wasn't always, as interest rate rose, the prices of your total portfolio went down. So we, as I mentioned, we introduced preferreds, especially rate reset preferreds. I don't know if you're all, I mentioned them last year that we were buying them and the year before. Basically, the rate reset preferreds are a preferred whose dividend changes when interest rates go up. So rather than a typical straight preferred where interest rates go up and the price of the preferred falls, these bonds, these preferred equity shares actually rise when interest rates go up. So they provide some diversification against that 70% in your portfolio of bonds that will fall in price when interest rates rise. So, 6 years later, here are the returns. As you can see, you look at the second column from the left, the one-year return. The total return on the Tradex bond fund, or your Tradex bond fund, was 10.3%. Bonds were 4.1 compared to 1.5 for the Universe Bond Index. Common shares and REITs, the smaller companies we have in the fund, 25.3% compared to 18.6%. And preferred shares, which had a significant rally after selling off the year before, your fund, the preferreds that in your fund, which are about 16% of your fund, returned 28.2% compared to the index of 21.9 and 24%, depending on whichever index you'd like to use. And we like to use the TSX, but we want to show you the minimum preferred share index as well. So we feel that that's accomplished the objectives, and you can see from a longer-term perspective, the Tradex bond fund at 6.4% compared to the TMX Canada Bond Universe at 4.5% has more than accomplished the objectives. And that's been done without a lot of excess volatility. It's not like you're in a Toronto Stock Exchange type fund where you're going up and down every day with the market. It's been a very smooth rate of return over time, and we're quite happy that it's accomplished those objectives. And obviously the returns are outsized. We can't promise that these type of returns forever. It has been a unique period, especially over the last 5 or 6 years. But we're really designing the fund to generate about a 4 or 5% income yield every year without taking a huge amount of excess risk. We don't want to buy a bunch of stocks in the portfolio that are going to be extremely volatile so that you get great capital gains one year and huge capital gains the next. We really concentrate at Foyston, Gordon and Payne on credit. We have individuals in our credit department that come from the rating services. A couple of them come from the Muni Bond Rating Service. We spend a lot of time making sure that the companies we purchase, especially on the equity side and the preferred share side, can generate sufficient income to pay their dividends, pay their coupons on the bonds, without taking a significant risk of default on any of the bonds or preferred shares or common equities in the portfolio. Now, I've been told one of the other participants has been delayed, so I said I can go a little longer, which I've been around for 40 years, and most of that time has been bonds. And I don't think I've ever been told go a little longer with bonds, especially this time of night. So if you have any questions about bonds, I can go further with that. Well, just to take a look at the current portfolio. There we go. So as you can see, we're going to compare. We're comparing on the left hand. We're comparing on the left hand side the Tradex bond portfolio compared to the Universe Bond Index, because that's what we're trying to beat. And as you can see, we have a little bit of cash. We try not to have too much cash in the portfolio. We're trying to be fully invested at all times. We have about 40% in government bonds, 30% in corporate bonds, 16% in preferred shares, and 12.9% in common equities. That's really the maximum. We can't have more than 30% in equities. That includes preferreds. So we're pretty much close to as much as we can have in equities plus preferred equities. And we're comfortable with that. We think that's a good diversified portfolio. And it's throwing off, preferreds are throwing off a yield of 4.5% to 5%. The common equities in that 4 to 4.5% range. And it's adding to your return, and very low return yield of bonds are 1.5% to 2%. But as I said, we want to make sure that we're not going to have a portfolio that is extremely volatile, because that's not what I want, because I designed the fund, and that's not what I think unit holders want in their portfolio, especially when they're invested in other more risky asset classes like common equities, international equities, which you'll hear from later. So, just to take a look at the returns from March 2011. Actually, we added preferreds into the portfolio at the end of April 2011 when we got approval to do that. And as you can see, bonds, your bond fund, the bond portion, which is about 70% of your fund, is about 5% compound annual rate compared to the index of 4.5%. The preferred share index, and that's changed over time. We used to have perpetual preferreds, and over time, when rate reset preferreds became more attractive, we switched the portfolio. So about 2/3 of the preferred share portfolios in rate reset preferreds, and about 1/3 in your typical bond-like perpetual preferreds. So they did, our year portfolio did 6.8% compounded compared to 2.5% for the index. And common equities, smaller companies, not all small, there's a few bank stocks in there, some larger companies, but generally niche companies that can generate growing dividends and good return on equity without taking a lot of risk. They're not borrowing to pay the dividend, they're generating enough cash flow to more than significantly cover the dividend that they pay out. And as you can see here, common equities 11.5% compared to the Toronto Stock Exchange at 4.7%. Can't guarantee that for the future, as I'm told. It's been great, but generally we're just trying to get the income from those stocks, but we don't want to have a lot of, as I said, we want to have a lot of volatility. So you'll probably hear a lot tonight about people wanting to be conservative, and as I said, I've been in the industry for 40 years, and there's always a lot of risk. There's always a lot of geopolitical risk. There's always a lot of too much government debt. That's gone in cycles. There's almost always the end of the world thesis, and we're still faced with that today. I wrote these comments 2 weeks ago, and they're probably out of date right now. In fact, with Donald Trump in the presidency, 6 hours from now we'll be out of date because he changes his mind every 6 minutes, let alone 2 weeks. But if you really look at things that make us take caution, now granted you're totally in a Canadian fund, but obviously NAFTA may be a problem. I think in the press has really overblown the effect of NAFTA. There's a very strong trade relationship between Canada and the U.S., branch plants in Canada compared to branch plants in the U.S. That, once Trump gets through his rhetoric, I think if he has good advisors, I think that's not going to be as big a problem as the press lets it on to be. You read a lot about the dairy problem. Well, dairy is a very small part of the economy, but it's still a thing that brings things to the forefront. You hear a lot about the softwood lumber debate. Actually, the softwood lumber, everyone thought they were going to really get murdered in terms of price, but actually the softwood lumber stocks, and we own some in our main Canadian fund, actually went up over the last few weeks because the duties weren't as big as people expected. And since the 1930s, Canada and the U.S. have been at loggerheads over softwood lumber, and they've always reached conclusions. So I don't think that's really a problem for the portfolio longer term, or your portfolio, even though you're not directly, with our investments, exposed to that debate. Obviously, there's always a lot of geopolitical risk with North Korea. Anything could happen, Iran, the Middle East. But that's a continuing problem, and I don't think anyone can give you a really positive or negative effect on how to position a portfolio in that environment. But the one thing that hasn't really been reported in the press is the European markets. As you know, around the world, since the credit crisis, central banks have been pumping money into the system. They've been buying bonds, buying mortgage-backed securities, trying to get the economy going, what's called quantitative easing. Traditionally, from an economics 101 perspective, what happens is all that money from the central banks comes into the system. The first place it hits is the securities markets. The stocks go up. Eventually, that money works its way into the real economy, and things start over again, and we get a recovery, and everything's wonderful again until the next crisis. This time, since 08 and 09, really it hasn't worked that well in the U.S. In the U.S., we had obviously a big increase in security prices, and we're still seeing that. But the real economy hasn't responded to the same degree when you consider all the trillions of dollars that have been pumped into the system. But if you look at Europe, now it's been a while, but there's sort of been a stealth recovery in Europe. Even some of the weaker economies like Italy and Spain, they're starting to show growth. Now granted, unemployment rates are still at 12%, but that's down from 22, 23% 3 or 4 years ago. But it seems like Europe now is a place where we're going to see some growth. There's obviously political risk. People, with Britain leaving the EU or attempting to leave the EU, people obviously thought France was going to leave the EU as well. Recent election results suggest that maybe, there's more pro-Euro sentiment in France than we would have thought of at the beginning of the year. The Netherlands had an election and they went pro-Euro. So that's settled down, and it's also helped the security crisis. There again, just something to think about. As I say, it's not going to affect your portfolio of Ferraris, but the other presenters, it obviously will affect their portfolios more than this. But generally, it's really a push and tug. Obviously, President Trump has had more effect on the markets from a short-term basis than any other president probably in the last 20 or 30 years. But we hope that some semblance of order will come, because everyone he's employed under him as advisors aren't as sort of wacky as Trump appears to be. think I can go any longer, otherwise I'm going to fall asleep.